Why silver's terrifying plunge is actually fantastic news. Have you ever watched a soaring market suddenly plummet and felt that cold knot of fear in your stomach, the one that whispers the party is over? We are witnessing that exact scenario in the silver market right now. A breathtaking ascent has been met with a dizzying drop, shaking out market confidence and flooding online forums with declarations of a bull market's demise. After reaching a spectacular high of over 54 units of currency on October 16th, the price has retreated sharply, now struggling to hold the line at 50. This is precisely the kind of violent pullback that sends retail investors scrambling for the exits, convinced they have been left holding the bag. This sudden reversal has ignited a firestorm of debate and anxiety. For weeks, the narrative has been one of unstoppable momentum, a surge powered by a confluence of bullish factors that seem to promise only higher prices. The close on May 30th was just under 33. From that point to the peak just a few days ago, investors saw a gain well in excess of 50%. Even looking at a shorter time frame, from a close of roughly 36.5 at the end of July to that 54 peak, represents a phenomenal increase. An 18-point leap in under 3 months is the kind of move that defines a speculative mania, not a healthy, sustainable market advance. The core problem we must dissect is not the drop itself, but the parabolic and unsustainable nature of the preceding rally. Markets, like living organisms, cannot sprint indefinitely without pausing to catch their breath. A 47% gain in just 2.5 months is an anomaly in any asset class, signaling an overextension that must be corrected. This rapid ascent was fueled by a mix of genuine fundamental drivers and an unhealthy dose of speculative fever. It is this speculative component that is now being purged from the market, creating the illusion of a catastrophic collapse when, in reality, it is a return to a semblance of rational valuation. This period of correction presents a significant opportunity, though it is one cloaked in fear. The prevailing condition is one of emotional overreaction, where short-term price movements are mistaken for long-term trend changes. The inexperienced investor sees a 4 or 5 point drop and panics, viewing it as the start of a freefall back to previous lows. The seasoned economist, however, sees a market reestablishing a foundation. This is the moment to assess the underlying structural forces that initiated the bull run in the first place and determine if they remain intact. If those fundamentals are still strong, then this pullback is not a threat but a gift, a chance to accumulate a valuable asset at a discount. The primary catalyst disrupting the old status quo for silver is its indispensable role in the global transition toward green energy. This is not a future projection. It is a present-day reality that is accelerating at a pace that market participants are only beginning to appreciate. Silver is the most conductive metal on the planet, a property that makes it essential for solar panel production. Every photovoltaic cell contains a silver paste that conducts the electrons, and as the world ramps up solar installations to meet climate goals, the demand for this specific application is set to explode. This is a baseline of industrial consumption that is rigid and growing, providing a powerful tailwind for prices. Beyond solar energy, the electrification of the global vehicle fleet represents another monumental demand catalyst. Traditional internal combustion engine vehicles contain a small amount of silver, but electric vehicles require significantly more due to their complex electronics and battery management systems. The most exciting frontier, however, lies in next-generation battery technology. Solid-state batteries, poised to revolutionize the EV industry with their enhanced safety and energy density, are projected to be remarkably silver-intensive. Preliminary research suggests a potential usage of up to 1 gram per cell, which, in a typical EV battery pack containing 1,000 cells, translates to a full kilogram of silver per vehicle. Should this technological path become the industry standard, the implications for the silver market are staggering. We are talking about a potential new demand source that could rival, or even exceed, existing industrial applications. 1,000 grams of silver per car, multiplied by millions of vehicles produced annually, creates a demand figure that the current supply chain is simply not equipped to handle. This innovation alone has the power to fundamentally rewrite silver's supply and demand equation for decades to come, moving it from a peripheral precious metal to a critical strategic resource at the heart of the modern technological economy. Compounding this demand-side pressure is a persistent and worsening structural deficit on the supply side. For years, global consumption of silver has outstripped what is produced through mining and recycling. This is a critical point that many overlook. There is, of course, a large quantity of above-ground silver in the form of bullion, jewelry, and silverware. However, the annual flow, what is newly available to the market, is consistently falling short of what industry and investment demand. This deficit has been drawn from existing stockpiles, but those stockpiles are finite. Eventually, the ever-increasing consumption will collide with the reality of limited new production. The geology and economics of silver mining add another layer of complexity. The vast majority of silver is not mined directly. Instead, it is produced as a byproduct of mining for other industrial metals, primarily copper, lead, and zinc. This means that the supply of new silver is not principally determined by its own price, but rather by the global demand and production schedules for these other base metals. If a global recession were to decrease the demand for copper, for instance, copper mines would scale back operations, and the byproduct silver supply would plummet as a direct consequence, irrespective of how high the silver price might be. This byproduct dynamic creates a unique and precarious situation. For the market to incentivize a significant increase in silver output, the price would need to rise to a level that makes primary silver mining economically viable on a massive scale. The all-in sustaining costs for primary silver miners are substantial, factoring in exploration, labor, energy, and regulatory compliance. It is widely believed within the industry that a sustained price far above the 20 or 25 currency unit levels of the recent past would be required to bring significant new primary mines online. This economic reality establishes a functional long-term floor on the price, as direct mining becomes prohibitively expensive below certain thresholds. We are now approaching a potential tipping point, a critical juncture where the market's perception of silver undergoes a permanent transformation. This current price drop is not that tipping point, rather it is the tremor before the earthquake. It is the market's last gasp of normalcy before the underlying structural realities become undeniable. The true tipping point will arrive when a major industrial consumer, perhaps a national government or a consortium of technology companies, makes a strategic decision to secure a long-term physical supply, bypassing the paper markets entirely. This would be an open admission that future availability is a serious concern. Imagine a scenario where a major automaker, seeing the projections for silver demand in solid-state batteries, decides to build its own strategic reserve. Such a move would send a shockwave through the industrial world, triggering a domino effect as other manufacturers rush to do the same, fearing they will be left without the critical components for their products. This is the moment the narrative shifts from silver as a financial instrument to silver as an essential, irreplaceable industrial commodity. At that point, the price discovery mechanism would break free from the speculative whims of futures traders and become dictated by the desperate needs of industry. Another potential tipping point lies in the monetary realms. For millennia, silver has served as real, tangible money. In an era of unprecedented global debt and relentless currency debasement by central banks, the appeal of assets that cannot be printed into oblivion is growing. The tipping point here could be a crisis of confidence in a major fiat currency or a sovereign debt market. In such a scenario, capital would flee from paper assets into the safety of physical precious metals, and silver, being the more affordable and accessible monetary metal for the general populace, would experience an avalanche of investment demand that would overwhelm the available physical supply. The immediate impact of the current market correction is a clear differentiation between types of market participants. We are seeing the weak hands, the momentum chasers and leverage speculators being flushed out of the market. Their stop-loss orders are triggered, and their panic selling accelerates the downward momentum, creating the very price drop they feared. This is a classic market purge, a necessary process that transfers the asset from short-term traders to investors with a long-term conviction based on fundamental analysis. While it is painful for those caught on the wrong side, it is ultimately a healthy and stabilizing process for the market. Simultaneously, we observe the behavior of the smart money, the institutional players, the refiners, and the large-scale industrial users. They view this $4 dip not with fear, but with strategic interest. Their models are not based on daily price charts, but on 10-year supply forecasts, geopolitical risk assessments, and projected demand curves from emerging technologies. They understand the long-term structural deficit and view any significant price reduction as an opportunity to acquire a critical resource more cheaply. They are the patient accumulators who absorb the panicked selling from the retail sector, quietly strengthening their positions for the future. The aftermath of this consolidation phase will be the establishment of a new, higher, and more stable price floor. After the speculative froth is blown off, the market will search for a level of equilibrium where buyers and sellers can comfortably transact. This new floor, perhaps in the mid-40s, will represent a fundamental revaluation of the metal. It will be a price level that acknowledges the new realities of increased industrial demand and constrained supply. Once this foundation is solidified, it becomes the launchpad for the next sustainable leg of the bull market, one built not on mania, but on undeniable economic fundamentals. Consider the perspective of the dealers and wholesalers who form the backbone of the physical bullion market. During a parabolic price spike, their world is thrown into chaos. They face immense risk. If they purchase a large inventory of silver at 53, and the price corrects to 49 the next day, they suffer a significant loss. To protect themselves from this volatility, they widen their bid-ask spreads dramatically. They begin paying far less for the metal they buy back from the public, offering prices that can be 10 units or more below the spot price for certain products, which deters selling and disrupts market liquidity. This defensive posture from dealers is a crucial market signal. When buyback prices plummet relative to the spot price, it indicates extreme uncertainty and fear among the market makers themselves. They do not know where the top is or when the inevitable correction will occur. This recent drop, therefore, brings a degree of relief and sanity back to the physical market. As volatility subsides and a new price range is established, dealers can tighten their spreads again, restoring a more efficient and liquid marketplace for both buyers and sellers. This normalization is essential for the long-term health and credibility of the market. The psychological impact on the average investor cannot be overstated. Emotional swings are the greatest enemy of sound investment strategy. The euphoria of watching an asset spike in value is matched only by the despair of watching it fall. These emotions drive the worst possible decisions, buying at the peak of excitement and selling at the bottom of a panic-driven dip. The current environment is a real-world test of every investor's discipline. The ability to detach from the short-term noise and focus on the underlying thesis is what separates successful long-term accumulators from those who are perpetually whipsawed by market volatility. This cycle is as old as markets themselves. An asset with strong fundamentals begins to rise. The initial move attracts attention and momentum builds. Soon, speculators who know little about the asset's intrinsic value pile in, hoping for a quick profit. This creates a feedback loop that drives the price to unsustainable levels. Then an inevitable correction occurs. The speculators are washed out, vowing never to touch the asset again, while the fundamental investors use the opportunity to add to their core positions at better prices. A period of consolidation follows, and the cycle begins anew from a higher base. The key takeaway from this entire episode is that volatility is not the enemy. It is an opportunity disguised as a risk. For those who believe in the fundamental story of silver, a story of inescapable industrial demand, a structural supply deficit, and its enduring role as a monetary hedge, these pullbacks are not crises. They are moments of clarity. The world's problems did not vanish because the price of silver dropped a few points. The mountains of sovereign debt, the persistence of inflation, and the global imperative to build green infrastructure all remain firmly in place. What has changed is simply that a cohort of traders decided to take profits, and their selling triggered algorithmic trading programs and spooked a segment of the retail market. That is all. The fundamental case is not only intact, but continues to strengthen with each passing day. The long-term trajectory is dictated by the unchangeable laws of supply and demand, not by the fleeting emotions of day traders. This recent price action is merely noise on the path to a much higher future valuation that is being baked in by powerful, irreversible global trends. Let us put this massive drop into its proper perspective. Even after this significant pullback from the peak, silver remains up nearly 50% since the beginning of summer. If this is what a market crash looks like within the context of a powerful secular bull market, then it is a healthy and even welcome development. It demonstrates the market's ability to self-correct, to shake out the speculative excess, and to build a more resilient foundation for future growth. A market that only moves in one direction is a bubble destined to burst catastrophically. A market that advances, corrects, and consolidates is one with strength and longevity. Looking forward, we must anticipate that this will not be the last such correction. As silver continues its ascent in the coming years, there will be other periods of sharp, unnerving pullbacks. The path to a new monetary and industrial reality will not be a straight line. It will be marked by periods of extreme volatility, driven by profit-taking, shifts in speculator sentiment, and concerted efforts by entrenched interests to manage the price through the paper derivative markets. Each of these events will test the resolve of investors, and each will present a similar opportunity for those who maintain their focus on the long-term picture. The future prediction, therefore, is not about a specific price on a specific date. It is about a fundamental repricing of silver that reflects its dual nature as both a critical industrial metal and a foundational monetary asset. We will likely see the establishment of a new floor in the 40s, a level that will hold and provide a base for the next move. From there, the next major leg up will likely challenge and eventually overcome the previous all-time highs, driven by the relentless growth in demand from the green energy sector. This is not a matter of if but when. As the structural deficit becomes more acute, we will begin to see signs of genuine physical shortages. This may manifest as extended delivery delays, significantly higher premiums for physical products over the paper spot price, and eventually, reports of industrial users being unable to source the metal they need. This is the stage where the market transitions from a paper-driven pricing scheme to one dominated by physical reality. When factories are at risk of shutting down due to a lack of a critical component, the price elasticity of demand becomes almost zero, and the potential for a price explosion becomes very real. The monetary dimension will likely reassert itself with vigor. As confidence in the global financial system continues to erode under the weight of unsustainable debt and inflationary pressures, a flight to the safety of hard assets is inevitable. Gold will lead this charge, but silver's historic role and relative affordability will cause it to participate in a dramatic fashion. The gold-to-silver ratio, a historical measure of their relative value, is likely to compress significantly from its recent high levels, implying that silver will outperform gold during the most intense phases of this monetary reevaluation. Ultimately, this is not merely an investment thesis. It is an observation of a paradigm shift in progress. The world is simultaneously undergoing a green energy revolution and a slow-motion crisis of confidence in its fiat currency system. Silver stands squarely at the intersection of these two megatrends. Its physical properties make it essential for the future of technology, while its monetary properties make it a timeless store of value in an uncertain financial world. This dual identity is what makes it one of the most compelling assets of our time. Therefore, the lesson to be learned from the current market volatility is one of perspective and conviction. Do not be swayed by the short-term noise generated by panicked headlines and emotional commentary. Instead, focus on the powerful, long-term fundamental drivers that are reshaping the silver market. These drivers are not cyclical, they are structural and transformational. The increased demand from new technologies is permanent. The constraints on supply are real and worsening. The erosion of purchasing power in paper currencies is a mathematical certainty. This pullback is a brief moment of sanity in a market that has been, and will continue to be, explosive. It is a necessary and healthy function of a market that is in the early stages of a powerful secular bull run. For those with the foresight to understand the profound changes underway, this is not a time for fear. It is a time for quiet accumulation, for strengthening one's position in one of the most undervalued and fundamentally sound assets on the planet. The real story is not that silver fell $4 today, but that its long-term value proposition has never been stronger.